The trash monopoly, why Wall Street wants your garbage, and why your bill is about to explode. The email hit at 7:42 a.m. Effective immediately, your monthly service rate increases 40%. One landfill contract had just changed hands. By noon, phones lit up across town. Same bins, same trucks, suddenly bigger bills. Opting out wasn't an option. Late fees stacked. Recycling contamination, fines pinged by camera. On the earnings call, they called it yield. Here's the thing, you don't own your trash anymore. Wall Street does. They turned garbage into an unskippable subscription with CPI pass-throughs and penalties that never sleep. Today, we're tracing how a basic city service became a financial product, and why your next bill is primed to rise. How trash became a financial product. To understand why one contract flip can spike a city's bill, we need to go back to a quiet truth about garbage. It's hyperlocal until someone controls the exit. For decades, waste was a patchwork. Municipal crews on one block, family haulers on the next. That fragmentation hit a gold mine called route density. More stops per mile means more profit per hour. Whoever stitches dense routes together can print predictable cash. But density only pays if you control where the loads end up. Landfill permits are scarce, slow, and expensive. If you control disposal, you control price. That's the moat. In the 199s, national players started knitting routes, transfer stations, and landfills into one pipeline. After the 2008 crisis, private equity floored the accelerator with roll-ups. By local haulers, feed their tonnage into your transfer sites, tip at your landfills, capture every dollar on the way down. By 2024, consolidation wasn't just a trend, it was a balance sheet strategy. Public operators spent roughly $10.9 billion on acquisitions in a single year, a surge from 2023. The Big Three, Waste Management, Republic Services, and Waste Connections, command about 65% of U.S. market revenue. That much control isn't just trucks and dirt, it's finance. Wall Street loves inelastic demand, and municipal garbage contracts deliver it. Contracts became instruments. Cities signed multi-year franchises with CPI pass-throughs. When inflation ticks up, rates reset automatically, often CPI plus a percentage. Fuel surcharges float on top. Cart rental, overage, and contamination fees add rungs to the ladder. Those steady, enforceable cash flows backstop debt. Private activity bonds for transfer stations and landfills, corporate revolvers, project financings. Your Tuesday pickup supports a capital stack. Meanwhile, recycling flipped. For years, commodity revenue from cardboard, aluminum, and some plastics softened program costs. In 2018, China's national sword slammed the door on mixed paper and plastics, ratcheting contamination tolerance near zero. Export outlets vanished. MRF slowed lines, hired more sorters, added optical tech, and then added processing fees with CPI escalators. Revenue sharing turned into you pay to move it. Cities that once booked a small recycling upside started writing checks. That's when the model locked in. Collection is sticky. People don't cancel trash. Tie that to disposal control, and you've got a captive stream. A city might rebid routes every decade, but the landfill permit on the other end rarely changes hands. Where capacity is tight, disposal scarcity gives the owner a lever. In the Northeast, average municipal solid waste landfill tipping fees hover around $80.67 per ton. Interior markets with more airspace sit far lower. Transport adds distance costs. Every mile is diesel, wages, and time. Unless you own the route, the transfer, and the landfill, and can tax each step. Put a small hauler into that map. They can win on service. They still need a gate. If the nearest public site is capped or an hour away, they tip at a private landfill, often priced 30% or more above public gates. Margins evaporate. That's vertical integration doing what it's designed to do. While that pressure built at the curb, franchise agreements at City Hall got longer and more complex. CPI plus escalators. Fuel adders that rise fast and drift down slow. Contamination penalties enforced by RFID chips in carts and cameras on truck arms. Extraordinary event, clauses to raise rates midterm when disposal jumps. The language sells efficiency and compliance. The math sells predictability to investors. On earnings calls, the KPIs are all yield, EBITDA per route hour, yield per household, disposal capture rate. Each acquisition plugs new tons into existing transfer stations and landfills, boosting utilization. Synergies, yard consolidations, standardized fleets, shared dispatch, drop to the bottom line. Debt funds the spree. The contract cash flows service the debt. Securitization thinking creeps into everyday fees. A contamination penalty isn't just discipline. It's a micro-escalator that smooths volatility. A cart replacement charge isn't just cost. Recovery, it's a tiny annuity. Enough of those across enough households, and your city's solid waste line looks like infrastructure asset-backed cash flow. Steady, indexed, and enforceable. National Sword removed the old release valve. Municipalities cut glass, landfilled mixed paper, or paid higher processing costs. Public messaging focused on cleaner sorting. Private strategy focused on margin protection. Both were real. Only one decided your bill. Here's the irony. It didn't feel like anything changed. Same trucks, same carts, same pickup day. Behind the scenes, your bin became a line on a yield model, and your city's franchise became collateral. In regions where the gate price anchors high, think that Northeast $80.67 per ton. The contract's escalators and pass-throughs harden around it. When a landfill contract flips, the bill moves. When $10.9 billion of roll UPS pull more routes into the same integrated networks, more bills move together. That's how trash became a financial product. A local ritual wired to indices, layered with fees, underwritten by scarcity, and sold to lenders as predictable cash. From the street, it's still Tuesday. From finance, it's a metronome. The Route-to-Landfill Chokehold. Follow one truck from your block to the scale house. The logo on the door is just the opening scene. Control lives at 3 gates: your curb, the transfer station, and the landfill. When the same company owns all 3, every mile becomes a toll they collect, from you and from anyone who tries to compete. It starts with an exclusive franchise. City Hall awards one operator the right to collect for 7, 10, sometimes 15 years. That locks the curb. One set of carts, one schedule, one bill. Meanwhile, the same operator owns the transfer station, the middle mile where route trucks dump, plus the landfill with the permit everyone needs. Vertical integration isn't just efficiency, it's leverage. If you don't own disposal, you pay disposal. If you do, you set the price. Tipping fees are the blunt instrument. In the Northeast, the average municipal solid waste landfill gate price sits around $80.67 per ton. That's not a number on a slide. It's an anchor for every invoice tied to those tons. Interior markets with more airspace are cheaper. But geography doesn't just change the fee, it changes the distance. When a closer site closes for liner work or stops taking third-party loads, trucks drive farther. Every extra mile is diesel, wages, maintenance, and time. Contracts let operators pass distance and fuel through as adders. Those adders float up fast and drift down slow. Now drop a small hauler into that map. They can win a neighborhood on service, clean alleys, quick swaps, a driver who knows the names on the block. They still need a gate. If the public landfill is capped on outside tons or an hour away, they're pushed to tip at a private site that often charges 30% or more above public gates. That spread turns a margin into a slow bleed. And here's the kicker. The integrated operator now collects twice, from the competitor at the scale and from the competitor's customer when the price hike lands. Transfer stations are quiet profit centers. Each tip pays a transfer fee, then pays again at the landfill. When both belong to the same owner, internal market rates can move value between entities while keeping economics inside the family. On a quarterly report, it looks tidy. On the street, it feels like a ratchet, a base rate on the curb, a transfer fee in the middle, and a disposal charge at the end, all indexed, all enforceable. Time is the soft weapon. Queue length and priority access decide how many stops a driver can make before lunch. If you own the site, your trucks clear first. Outsiders wait in the heat, burn hours, and eat overtime. Miss a scheduled pickup because the queue stole a shift, and the commercial customer pays an on-demand premium the next morning. Dispatch windows are policy on paper and pricing in practice. Exclusivity tightens the vice. Route protection clauses keep rivals off your streets. Bundling requirements, garbage, recycling, organics together, prevent a nimble competitor from peeling off one stream. And access rules at the middle mile can do the rest. Limited outside hours, higher minimums, strict contamination thresholds that push outsiders into reclassification. Officially, it's safety and compliance. Functionally, it's a filter that raises costs for anyone without the house logo. Price elasticity finishes the job. Households can't cancel trash the way they cancel streaming. Inelastic demand gives operators the confidence to hardwire CPI pass-throughs and disposal indices into contracts. In a region where the gate sits near $80.67 per ton, a single capacity shock can ripple into double-digit jumps citywide. Extraordinary event clauses activate. The reset sticks into next year's base. Here's how that looks at your address. You set out an extra bag after a move, overage charge. The lid won't close on the blue cart, overflow fee. A camera flags a plastic bag in organics, contamination fine. None of these line items are huge alone. Together, they're a cushion that absorbs volatility, smooths the month, and protects yield when diesel jumps or a nearby cell shuts down. Meanwhile, integrated owners can shape the playing field with logistics. Close a small yard, consolidate into a larger depot near your transfer station. Shave minutes off every loop. Standardize trucks and parts. Feed every new acquisition's tonnage into your own middle mile. Utilization at the transfer station rises. Fixed costs at the landfill spread over more loads. Each route hour throws off more EBITDA. The competitor across town, still waiting at your scale, watches their cost per stop creep. Residents don't vote on any of this. Landfill permits run decades. Transfer stations sit on scarce industrial land with highway access. Once the route-to-landfill pipe is under one brand, the city's leverage narrows to contract terms and enforcement. When a merger stacks too much in one metro, antitrust can force a divestiture. A transfer station sold here, a route there. Those are important relief valves. Day to day, the chokehold is structure, not scandal. The math is simple and cold. Own the curb, own the gate, own the hole, and you control the clock. The rest of us meet it in the only place we can, on the bill. City Hall as a profit center. While the chokehold works at the scale house, the real leverage gets inked across a conference table under fluorescent lights at City Hall. The pitch arrives polished, cleaner fleets, standardized carts, fewer complaints, sustainability investments. The deck promises service. The contract plants the meter, CPI pass-throughs, fuel surcharges, disposal indices tethered to regional tipping fees, and contamination penalties enforced by RFID and cameras. On the operator's side, those clauses turn variable costs into predictable yield. On the city's side, they create a steady revenue share called a franchise fee. Watch how the auction gets tilted. Terms stretch 7, 10, even 15 years, with auto-renewals if complaint rates stay under thresholds an incumbent can easily meet. CPI escalators often read CPI+. Not just CPI, hardwiring annual increases. Add fuel adders that rise fast and drift down slow, and extraordinary event clauses that trigger mid-cycle adjustments when disposal spikes. Like when a Northeast landfill anchors near $80.67 per ton, or a closer site pauses third-party access. On paper, that's risk-sharing. In practice, upside is privatized and downside socialized. Now open the RFP fine print. Minimum fleet age, engine standards, route analytics, cart cameras, compliance that sounds modern and screens out undercapitalized challengers. Insurance limits sit high. Indemnities lean toward the city. Performance bonds tie up cash. The incumbent already owns compliant fleets and software across town. A newcomer prices those requirements, blinks at the bond, and trims the margin. When envelopes open, the best value bid is a few dollars lower up front, and a staircase of CPI+ for a decade. Scoring rubrics decide winners before a vote. Heavily weight experience and disposal ownership, sprinkle points for innovation, and front-load credit for sustainability projects the incumbent already built. If the same operator controls the transfer and landfill, they promise market-based internal rates. The city rarely gets the unredacted math. Meanwhile, franchise fees, 2, 3, sometimes 5% of gross receipts, flow to the general fund. That quiet dependence shapes behavior. Driving a harder bargain means shrinking your own budget. Contract opacity does the rest. Line items breed. There's a processing fee at the MRF with CPI escalators, a cart rental line, a cart replacement charge, a driveway distance surcharge, and camera-verified contamination fines. Ask for the formulas and you'll meet proprietary redactions. Staff reports summarize regional competitiveness, without showing how a disposal index is built, which sources it uses, or why private gates in permit-tight regions run roughly 30% or more above public sites. The rate design becomes a black box that always opens upward. Here's the microstory that repeats. A council meeting runs long. The solid waste item lands near the end. A consultant references index alignment and best practices. Staff notes labor, diesel, and disposal pressures. No one unfurls a regional map of landfill permits or reads the Environmental Research and Education Foundation's 2024 finding that regional averages diverge sharply, with private landfills typically charging well above public gates. The vote is unanimous. The bills arrive. The franchise fee hits the ledger. The next budget workshop thanks sanitation revenue for stabilizing parks. Meanwhile, the revolving door spins quietly. Former public works directors advise bidders. Ex-city attorneys draft clauses they once enforced. Fluency isn't scandal, it's leverage. They know which committees stall, which service metrics never spike, and how to frame escalators as index alignment rather than rate hikes. The language lands soft. The escalators land hard. Education becomes enforcement with a revenue tail. RFID chips timestamp lifts, cameras flag violations. First notice, second notice, then a fine. The city calls it behavior change. The operator calls it compliance. Lenders call it predictable collections. Those $5 and $10 events shave volatility off the cash curve that backs private activity bonds for transfer stations or RNG projects. In tender books, it's automated compliance. At your house, it's a photo of a pizza box and an extra line on the invoice. Cities do get wins. Some secure caps, CPI with floors and ceilings instead of one-way ratchets. Others demand sunset clauses on fuel surcharges and independent audits of contamination algorithms before fines stick. A few negotiate data ownership so penalty thresholds can't hide behind trade secrets. And when mergers stack too much power, antitrust remedies sometimes pry loose a transfer station, giving independents a place to dump at posted rates. Those inches matter, but structure drives outcomes. The franchise fee ties the city's budget to the operator's top line. The operator's top line is indexed to CPI, fuel, and disposal in permit-tight geographies where $80.67 per ton is the anchor. The fine print converts exceptions into schedules. The technology converts schedules into enforcement. By the time the next RFP cycles, the precedent reads like policy. Here's the line nobody says out loud in the chamber. City Hall isn't just buying service, it's sharing in a metered product. The more predictable the product, the cheaper the operator's debt, the richer the acquisition pipeline, and the steadier the franchise skim. That's why the big three, now around 65% by revenue, can roll up routes, roughly $10.9 billion in one recent year, and slot them into the same indexed machine. The meter turns. The budget balances. The resident pays. Recycling's broken promise. The pivot started with a single memo and a hard number. Contamination had to be nearly zero. In 2018, China's national sword shut the door on mixed paper and plastics, turning a global outlet into a brick wall. Overnight, bales that used to move sat. Warehouses filled. Export brokers stopped returning calls. And inside material recovery facilities, the line slowed like someone hit a brake. MRF managers added sorters. Some slowed belts by 40% just to catch film, caps, and stray food. Others bought optical sorters on debt, betting cleaner bales could still sell somewhere. Costs doubled in places. Commodity checks that once softened program budgets disappeared. In their place came a new word on city invoices: processing fee. Here's where the story bends from civic ritual to financial product. For decades, many cities got a share of revenue when cardboard and aluminum fetched good prices. When the market dipped, they felt it. After National soared, the contract flipped. MRFs began charging to take the same stream, pegging those fees to CPI so they rose automatically each year. Revenue sharing became fee first. The index did the lifting. Residents were told to sort better. They did. Carts got cleaner, less wish cycling, fewer tanglers, more rinsed containers. But the fee structure didn't unwind with behavior. Processing charges stayed, now indexed. Commodity rebounds, cardboard up a quarter, pet firmer the next, didn't trigger refunds. Instead, they padded margins against the next dip. Variable markets got replaced by steady invoices tied to inflation. Technology turned mistakes into money. RFID chips under lids time-stamped every lift. Cameras on truck arms snapped a shot as carts dumped. At first, letters coached. No plastic bags in the blue cart, no coffee cups with plastic lids, no greasy pizza boxes. Then the fines arrived, $5, $10, $20 for repeats. Automated by thresholds only the vendor could see. A photo, an address, a line item. Education became enforcement with a revenue tail. Meanwhile, Capital found a green pitch it understood. Operators framed new optical sorters, bunker upgrades, and baler overhauls as sustainability investments. ESG funds like the slides, lenders like the covenants. The cash flows looked familiar. CPI-linked fees, multi-year terms, enforceable penalties. Recycling's volatility got ironed into predictability that could back bonds for facilities and corporate debt for acquisitions. Tuesday's blue cart joined Tuesday's black cart as collateral. On the ground, the human math got weird. A family doing its best still tripped flags for a plastic film or a compostable-looking fork that wasn't certified. The first month, a warning. The second, a fee. The third, a higher one. Appeals lived inside a vendor portal with proprietary algorithms. Cities saw dashboards with contamination rates trending down. Households saw invoices trending up. Here's the stakes beat most people missed. When recycling paid for itself at the margin, it acted like a pressure valve on trash costs. When it turned into another indexed utility, it became a second meter. Now you pay to move garbage, and you pay to move recycling, with penalties if either stream blurs. The bins didn't change color. The contracts did. MRFs weren't villains. Their inputs flipped. China once bought the world's scrap. By 2021, that window was shut. Domestic demand existed, but couldn't absorb mixed bales at historic volumes and prices. So operators did what operations do under financial pressure. Reduce exposure to commodities, increase exposure to contracts, and use tech to tighten collections. Each step is rational. Together, they harden bills. Meanwhile, another lever clicked in regions where disposal already anchored high. In the Northeast, where average landfill tipping fees hover around $80.67 per ton, any load reclassified from recycling to trash at the scale carries a bigger hit. One plastic bag in a bale? A dock camera flags it. The load gets downgraded, the gate charges the higher rate, and a reprocessing fee rides along. That penalty stack reinforces the processing fee regime, not the other way around. The sales pitch didn't lie. Cleaner streams are better. Less contamination means more material actually gets recycled. But the financial truth sat beside it. Fee ladders climbed regardless of quarterly commodity swings or resident effort. CPI escalators didn't reverse. Fuel adders rode along. Extraordinary adjustments stayed after temporary shocks. A few cities pushed back with structure. They capped contamination penalties, required independent audits of camera false positives, and demanded that a share of commodity rebounds offset processing fees. Some kept public ownership of MRFs, setting transparent processing rates and publishing formulas. Others negotiated floors and caps, CPI with a ceiling, not a ratchet, and insisted on open books when private activity bonds financed upgrades. Most didn't. The processing fee survived every hearing. The index refreshed each year. And the blue cart, once a civic feel-good with a little upside, became another metered lane in the same financial highway. The promise didn't vanish. The Wall Street model, predictable cash, hidden levers. From the curb, it's trucks and bins. From finance, it's a ladder of levers that click in sequence. Start with route density. Pack more stops into fewer miles, and your cost per household drops. Tie those stops to your own transfer station and landfill, and every ton pays you twice. In regions where disposal anchors high, like the Northeast's average around $80.67 per ton, that second payment isn't just icing, it's the cake. Then hardwire indices. CPI pass-throughs sit in the franchise like a metronome. If inflation prints, your rate resets, often CPI plus a few points. Fuel surcharges ride on top, temporary in theory, sticky in practice. Disposal pass-throughs peg the base to a regional gate price. If that anchor lifts, or if a closer site pauses outside loads and miles stretch, an extraordinary event clause opens the door to a midterm reset that rarely walks back. Vertical integration turns each adjustment into margin. Own the route, the transfer, and the landfill, and you decide where revenue lands. A transfer fee here, a gate rate there, both inside the same family. Third-party haulers? They pay your gate, often roughly 30% higher than public sites, funding your margin while they try to compete. The more you capture, the smoother your cash. The smoother your cash, the cheaper your debt. Debt is the accelerant. In 2024, acquisition spend hit about $10.9 billion. Those deals weren't fueled by hope. They were financed against indexed, inelastic municipal cash flows. Lenders and pensions hear the same pitch: multi-year franchises, CPI-linked escalators, limited substitution risk, and scarce disposal permits. Layer on scale, waste management, Republic services, and waste connections now around 65% of revenue share, and volatility thins. Yield looks safe because the customer can't opt out. Inside ops, the cockpit glows with KPIs: EBITDA per route hour, yield per household, disposal capture rate, missed pickups per thousand, queue time at the scale. Close a small yard and consolidate dispatch. Standardize trucks and parts. Feed each acquisition's tons into your transfer station. Prioritize your own fleets at your gate. Minutes fall off loops. Fixed costs spread across more loads. EBITDA per hour lifts quarter after quarter. It reads as synergy. It spends like leverage. Now bring in technology. RFID chips timestamp lifts, link addresses to carts, and settle missed pickup, disputes with a scan, not a phone call. Cameras on arms verify contamination. Route analytics squeeze idle time and resequence stops. That data doesn't just improve service, it underwrites enforcement. A city sees education dashboards. A lender sees automated compliance and lower collection risk. The same photo that triggers a $5 fine also shaves a basis point off a facility's financing. Securitization thinking hums beneath it. You don't need to sell the contract to make it behave like a bond. You need stable, enforceable, index-linked fees and a covenant spine. Private activity bonds fund the transfer station. Their debt service rides on franchise cash flows with CPI escalators and disposal indices. Corporate revolvers rest on a portfolio of these local ladders. Each city is a tranche, each clause a covenant, each camera-verified fine a volatility dampener. Recycling's post-2018 flip tightened the weave. When China's national sword ended the export outlet, MRFs replaced commodity swings with processing fees tied to CPI. Contamination penalties became metered add-ons, photo-verified and hard to dispute. Suddenly, the blue cart mirrored the black cart, an indexed base plus enforceable surcharges. For underwriting, that's two independent streams with similar protections. For households, it's 2 meters you can't skip. Organics adds a third. Mandated green carts come with their own CPI escalators, contamination enforcement, and where private owners run landfills, a second ledger in renewable natural gas. The same banana peel feeds 2 models, tipping fees on the waste side and energy credits on the project side. Unless contracts require revenue sharing, those ledgers don't meet on your bill. Scarcity completes the loop. Landfill permits take years, attract lawsuits, and rarely proliferate near population. When capacity tightens, liner work here, slope repair there, miles rise and so do pass-throughs. In markets like the Northeast, where the gate already averages around $80.67 per ton, each shock bakes a new step into the staircase. In interior regions, the anchor is lower, but distance can substitute for price. Either way, extraordinary adjustments find a home. Investors want that story. Pensions, endowments, and infrastructure funds are told this is an inflation hedge with captive demand. When CPI rises, rates reset. When diesel jumps, surcharges float. When disposal lifts, indices pass it through. Volumes are steady because humans always make trash. The Big 3 scale makes labor, parts, and software cheaper per ton. Acquisition pipelines refill routes. Synergies drop in. Guidance hits. Residents meet it on the invoice. A base rate index to CPI. A fuel adder that retreats slower than rack prices. A disposal pass-through referencing a gate you'll never see. Contamination and overage fees that arrive with photos and footnotes. A gentle email offering priority pickup for a monthly premium. Each piece sounds small. Stacked, they protect yield, month after month, year after year, no matter what the commodity chart says. That's the model. Density lowers cost, integration multiplies revenue, indices harden price, technology enforces behavior, debt scales it, and scarcity blesses it. From finance, it's elegant. From your kitchen table, it's a ratchet. C&D, medical, and hazardous, the premium tiers. Commercial dumpsters tell a different story than your curb. Roll-off boxes land like mobile cash registers. 40 yards of demolition debris priced on the clock and at the gate. In construction and demolition, weight is heavy, deadlines are tight, and disposal control decides who pays whom. If the same operator owns the drop-off lane and the burial ground, the rental clock and the scale house tick in sync, and both tick their way. Here's the play. A contractor orders a box. The quote bundles delivery, daily rental, pickup, and tonnage. Go over the ton limit, and the meter jumps. Mix the load, drywall, wood, concrete, rebar, and contamination penalties kick in. Now add geography. If the nearest public landfill is limited to locals or booked, that box tips at a private site, often priced roughly 30% above public gates. In the Northeast, where average landfill fees hover around $80.67 per ton, that spread stings. It doesn't just hit the contractor. It climbs into the building budget, the rent, the sale price. Timing turns screws. A late swap idles a crew and burns thousands in labor. If you own both fleet and dump, your box is clear first. If you're an independent, you wait at the scale, bleed hours, and pay the higher gate. Over a season, the integrated owner becomes the safe choice. Safety is a price, not a promise. Transfer stations do quiet work here too. Many C&D loads stop at a dedicated pad, get pre-sorted for concrete or metal recovery, then move to landfill. Each touch is a fee. When both the transfer and the landfill sit under one corporate roof, market rates can shift value internally while keeping cash in the family. To a client, it's a single invoice. To finance, it's two revenue lines with one customer. Medical waste lives inside a tighter moat. Regulations demand sealed containers, cradle-to-grave tracking, certified treatment, usually autoclave or incineration, with audits that chase mistakes. The per-pound rate runs multiples of municipal trash because liability never sleeps. Hospitals pay for certainty. Clinics can't experiment with vendors the way a restaurant shops for linens. Compliance officers renew with providers that pass inspections and show service history. Volume is steady. The fear premium is real. Operators know it, and they priced it. Hazardous and e-waste raise the walls higher. Not every region has a treatment, storage, and disposal facility that can lawfully accept sludges, solvents, contaminated soils, or boards with heavy metals. Permits are rare and fragile. Neighbors law you up, timelines stretch. When only a handful of gates exist across a state, price becomes captive by design. Manufacturers don't haggle over every pickup. They lock terms at firm escalators to keep regulators and headlines away. Then there's disaster debris. A wildfire, a hurricane, a flood, and suddenly hundreds of thousands of tons have to move fast. Emergency contracts open, overtime runs, temporary staging sites appear, and tipping fees rise under extraordinary conditions. Federal reimbursement arrives later. The near-term checks still land in the same accounts. Capacity that felt fine in May becomes scarce in September. The operators with airspace, trucks, and transfer capacity harvest the surge, then reset the base to reflect new realities. Here's what doesn't show up on the glossy slide. Residential routes anchor the footprint, guaranteed stops, predictable lifts, a floor of indexed revenue. But premium tiers do the lifting on margin. Roll-offs priced by the ton and the day. Medical streams priced by the pound and the chain of custody. Hazardous, priced by the permit and the distance to the only legal gate. Disasters, priced by urgency and access. That spread funds fleet refreshes, debt service, and the next acquisition that pulls more tonnage into the same stack. Geography decides the slope. In permit-tight metros, every stream pays a toll. A downtown teardown schedule swaps around gate hours and pays top dollar at $80.67 per ton anchor. A hospital in a state with limited treatment capacity signs long terms at CPI plus escalators and sleeps better for it. A data center replacing racked ships e-waste across counties, eats fuel and minimums, and learns that posted rates are the floor, not the number. Interior regions feel softer, but leverage shows up as miles. Cheap gates far away still mean diesel, wages, and time. From the street, it looks like specialized bins and different colored bags. From the ledger, it's a tiered menu where the highest risk streams by the most certainty at the stiffest price. When boardrooms talk about yield expansion, this is what hums under the word. When you see another neat roll-up close, this is what paid for it. And when your Tuesday bill climbs on schedule, this is part of the reason it doesn't need volume to grow. Environmental justice and the siting game. Trace the route map of any big metro, and the pins cluster the same way. Transfer stations along freeways and rail, landfills on the edge of town, all pressed up against neighborhoods with the least room to push back. That pattern isn't a plot, it's a process. Siting doesn't reward passion. It rewards stamina, consultants, and calendars most residents can't match. Sit inside a permit hearing. The operator arrives with air dispersion models, traffic counts, noise studies, and mitigation plans. They've pre-met with staff, workshopped language, and sequenced filings to survive appeal. Residents bring lived experience. Trucks idling before sunrise, diesel haze when heat sits still, litter snagged in fences, property values that never climb the way the brochure promised. The hearing isn't a single showdown. It's scoping, a draft environmental review, comments, revisions, late-night sessions, continuances. People with kids and 2 jobs can't live in that calendar. Months pass. Files thicken. Fatigue does quiet work permits can't show. Host fees sweeten the deal. Dollars per ton flow to general funds or sanitation budgets. Parks get repaved. A rec center opens Saturdays. A pothole crew expands. It looks like compensation. It behaves like dependency. A city that has learned to count on host fees weighs no against a hole in next year's spreadsheet. Meanwhile, the properties closest to the gate wear a scarlet letter. Appraisers adjust comparables. Brokers whisper, it's fine most of the year. Buyers ask about smell in July. Equity bleeds in private, while host fee graphs cheer in public. Green language wraps the package. Methane capture becomes renewable natural gas. Flare stacks become energy projects. Slides tally carbon avoided by diverting organics or capturing landfill gas for pipelines. Those systems matter. They cut emissions and create revenue. They also justify expansion. Modernization needs larger cells. Optimization means more inbound tons. The same pipe that ships gas to a utility sends a signal to City Hall. Growth wears a halo if the deck is green enough. Regional scarcity sets the price of these choices. In permit-tight corridors, one closure for liner repairs can ripple across counties. Trucks drive farther. Doors shut to third-party loads. Pass-throughs click. In the Northeast, where average municipal solid waste tipping fees hover around $80.67 per ton, each shutdown pushes the anchor higher and stays embedded in the next franchise reset. A neighbor miles from any gate still funds the shortage at the register. Enforcement is where promises get tested. Permit conditions say no trucks before 6 a.m., covered loads, street sweeping. No idling beyond 5 minutes. RNG online by Q4. Headlights show at 5:41. A tarp rips, confetti flies. A sweeper misses a week. Supply delays push a gas project. Each violation has an explanation. Fines get paid. Operations continue. For the block breathing it, the difference between variance and violation feels like paperwork. Technology could balance the scales, but it usually points inward. RFID chips on carts and cameras on truck arms enforce resident behavior with photo-verified fines. The same precision rarely polices queues outside a transfer station. Residents ask for live dashboards showing truck counts and wait times, route geofencing to keep haulers off school streets, automatic penalties for off-route shortcuts. Some cities adopt these tools. Many don't. Data stays inside the gate, where it protects yield, not lungs. There's a deeper math tying justice to price. Neighborhoods hosting facilities are often the same ones least able to absorb bill shocks. A 12% increase hurts more when wages lag and rents climb. But residents don't vote on tipping fees. They can organize and delay a permit, extract conditions, and force hearing after hearing. They can't conjure capacity or bid a rival landfill into existence. Scarcity, timelines, and capital sit with operators. Oversight sits with regulators whose calendars bend toward perseverance. Closures reveal the system's design. A host community fights, wins a shutdown, and breathes easier. Trucks divert. Disposal indices. Spike. Extraordinary event clauses awaken. Staff memos cite regional market conditions. The next quarter's rates lock higher. The celebration is real. So is the spread cost paid by households who never smelled the site. By design, impact is local while pricing is regional. Communities aren't powerless. Coalitions partner with pro bono lawyers to mine appendices for soft spots. Traffic models that missed a school opening, air baselines taken on rainy days, hue assumptions that ignore seasonal surges. Conditions get tighter. Shorter haul windows, buffer trees, sound walls, electric truck pilots on city routes, automatic penalties for queue spillover, transparent public dashboards. Some towns negotiate host community agreements with escalating benefits, health monitoring, and clawbacks when violations stack. A few secure municipal ownership or co-ownership of transfer stations financed with public or tax-advantaged dollars, forcing open access at posted rates so independents aren't priced into extinction. Policy can hardwire fairness. If a facility uses private activity bonds, require open hearings on gate rate calculations, and publish the disposal index sources and dates. Cap CPI escalators with floors and ceilings rather than one-way ratchets. Mandate independent audits of contamination camera false positives before any fines land. Demand raw data ownership so cities, not vendors, set and audit penalty thresholds. Tie host fees to measurable reductions in local burden. Air filters in schools, tree canopy, sidewalk repairs on truck routes, so dollars trace harm, not headlines. None of this flips the map overnight. Antitrust remedies can pry loose a transfer station after a merger, giving small haulers a lifeline. Municipal experiments can stumble and privatize again. Dashboards can go dark when a new contract cites trade secrets. But each inch widens a seam in a wall built by scarcity, indices, and time. The honest ask is simple. If one neighborhood carries the trucks, the dust, and the stigma, who carries the cost when the $80.67 per ton anchor moves? Show the math, in daylight, before the ink dries. The organics pivot, compost, RNG, and the new rents. The second cart arrived quietly. New color, new rules, new line on the bill. Mandates said separate food scraps and yard trimmings, or face penalties. The climate math was clear. Cut methane from landfills. The business math was cleaner. A second, mandatory subscription metered with the same tech and indexed the same way. Here's how the cart became a meter. Franchises bundled organics with garbage as a default. Base rates for both, plus contamination penalties if coffee grounds show up in trash or a plastic bag hides in the green bin. RFID chips already in black and blue carts got cloned to green. Truck arm cameras that flag bags in recycling now scanned for produce stickers and compostable-looking forks that aren't certified. The first month, an education letter. The second, a fee. The third, a higher one. The invoice sprouted a fresh spine of line items that never sleep. Inside City Hall, the slides glowed green: methane reductions, soil health, circular economy. Operators echoed the benefits, then walked through the numbers lenders care about. CPI-linked escalators on organic service, disposal pass-throughs for residuals, and contamination enforcement to stabilize collections. The blueprint from recycling's post-2018 flip slotted right in. Fee first. Index tied. Camera verified. Under the landfill cap, a parallel meter spun. Methane captured from decomposing waste became renewable natural gas. Projects scrubbed and compressed gas into utility offtakes sweetened by federal credits. Investor decks loved it. The engineering works. So does the pricing power when one company owns the landfill making gas, the routes feeding it, and the franchise guaranteeing steady inbound organics. Publicly owned sites sometimes keep tipping lower and share energy upside via rates. Privately owned sites often hold higher gates and book RNG revenue on a separate ledger. Two assets, one feedstock, different outcomes for your bill. Capital costs turned into moats. Industrial composting isn't a backyard pile. It's covered aerated static systems, negative air buildings, stormwater controls. Anaerobic digesters mean tanks, gas cleanup skids, CHP units, or pipeline interconnects. Land near cities is scarce. Air districts are strict. Permits drag. Incumbents pledge franchise cash flows, and sometimes future RNG credits, to finance facilities. A startup co-op with a leased yard meets zoning hearings it can't staff for a year. Policy meant to cut methane can, without guardrails, harden monopolies. On the route, contamination became currency again. A compostable-looking cup without certification triggered a warning. A green bag liner that wasn't truly compostable drew a fine. A garden stake buried under leaves pierced a load. The organics site reclassified it, added a surcharge, and passed it through. The same enforcement spine, RFID timestamps, camera images, proprietary thresholds, moved over intact. Appeals lived in vendor portals. Data stayed private unless a contract forced audits. The opt-out question surfaced and often died. Many ordinances made organics universal to preserve route efficiency. Even households that home compost paid for the cart. The logic was participation. The effect was a floor of guaranteed, index-linked revenue with automated enforcement. On the commercial side, restaurants and groceries got weight-based charges, locked lids, surprise audits, and on-demand pull premiums when alleys blocked scheduled service. Miss a pickup, pay a surcharge, reset at a higher cadence. The waste still moved. The yield still hummed. Here's the rub residents feel. If banana peels become pipeline gas and compost sells by the yard, why isn't the green line cheaper? The answer sits in capital stacks and contract silos. RNG projects finance against offtake contracts and tax credits at the facility entity. Household fees live in the franchise entity. Unless the city negotiated revenue sharing or rate offsets tied to energy output, those ledgers never meet. The climate wins count in a report. The dollars don't credit your invoice. Geography sharpens the edge. Diverted organics lower landfill tons at the margin, but in permit-tight regions where gates already anchor high. Think Northeast averages around $80.67 per ton. The organics bill doesn't replace the trash bill. It layers on. If the landfill owner also owns the compost site or digester, your tonnage still feeds the same family, either into a cell that makes gas credits or into a windrow that sells soil. Control of both doors turns policy into pricing. A few places rewired the structure. They kept organics facilities publicly owned or co-owned, set tipping rates in open hearings, and netted energy revenues against fees. They capped contamination penalties, required independent audits of camera false positives, and let households opt out with proof of home composting. Administration got messy. Bills got clearer. Most cities didn't. The second cart arrived. The CPI step clicked. The fine print grew teeth. Operators advanced their roadmap. Cross-sell kitchen caddies and liner subscriptions in the app. Offer priority pickup windows for a monthly add-on. Market a clean cart program with periodic washes to reduce contamination risk. Loyalty discounts for autopay. The retail veneer softened the enforcement tripod. Index, pass-through, penalty. This isn't a villain story. It's an incentive story. Mandates met finance. Technology met enforcement. Scarcity met capital. And a climate fix became another metered lane on the financial highway. The banana peel left your kitchen and turned into cash twice. Once on your bill, once as energy. Unless you negotiated for the second to reduce the first, the loop closes somewhere else. Technology, data, and subscription creep. The hardware looked harmless. Little RFID pucks under lids, a lens on the truck arm, a tablet on the dash. Then the data started to talk. Every lift stamped a time, GPS pin, and card ID. Every photo caught a no item. What began as route optimization became behavior metering. And once behavior is metered, it can be priced. RFID chips solved lost carts and missed lift disputes. They also solved proof. If your cart wasn't at the curb at 7:04 a.m., the scan showed it. If your address exceeded its volume allowance 3 weeks in a row, the system logged it. Pair that with arm-mounted cameras trained to spot plastic film in recycling or compostable-looking liners in organics, and education, turned into a clean stack of billable events. First warning, second warning, fee. In the cab, route analytics shaved idle time, resequenced stops, and flagged alleys that always cost minutes. What nobody outside ops saw was how the same software ran pricing experiments. Offer priority pickup to a few thousand households, guaranteed early window, reduced overflow charges, watch take rates, then expand. Surface, extra cart, subscriptions at tiered prices, and nudge with emails when usage spikes. The app pitched, the CRM nudged, the invoice closed. Subscription creep slid in with soft names. Service assurance, clean cart program, driveway service, a cracked lid, replacement fee, cart swap, service fee, driveway longer than 30 feet, distance surcharge, snow day, special access charge. Each fee sounded rational alone, cost recovery, safety, where. Stacked together, they built a second story on the base rate, indexed by CPI and insulated by enforcement. Dynamic pricing tiptoed into select grids. If an alley consistently blocked trucks and spiked over time, The system tagged addresses as hard to service and applied a differential. The city called it targeted fairness. Residents saw a penalty for living on an old map. Hearings showed heat maps of delays. Invoices showed a new line item tied to a dot on a screen. Commercial accounts met sharper teeth. Mist compactor pulls triggered on-demand rates at premiums. Weekend windows carried multipliers. Dock cameras reclassified loads from recycling to trash at the higher gate, plus an audit fee. Managers trained staff with laminated cards. Surprises still landed. Chaos didn't draw anger. It drew a price. Here's the pivot. Data is a mirror and a lever. It reveals where routes waste time and where customers bend rules. It also justifies new tiers. A neighborhood with chronic late setouts gets offered evening pickup for a monthly add-on. A restaurant repeatedly overfills gets nudged into a larger container with a term extension and bundle savings. An HOA with seasonal surges gets a holiday overflow package. None of this reads like a tax. It functions like lock-in. Privacy lines blur. Vendors insist images capture only contents. Residents see house numbers, kids' bikes, open garages in the frame. Public records requests for audit algorithms hit proprietary walls. Cities often don't own the raw datasets, driving their own penalties. The operator runs the system, sets thresholds, updates models. Electeds read dashboards. Underwriters read the same charts as proof of automated compliance. Then comes the cross-sell. The billing app starts surfacing offers. Bulky pickups at member rates, e-waste days with preferred slots, compost starter kits shipped to your door. Loyalty discounts appear, 2% off for autopay, 5% if you bundle organics and extra recycling. It feels like retail. It reduces churn and lifts revenue per account. Underneath, the bond math smiles. Each microfee smooths volatility. Each subscription tier lowers the chance a customer will contest a base rate increase. They're busy managing add-ons. Each camera-verified fine reduces dispute time. When a city floats bonds for a transfer station or signs a long franchise, these charts slide into appendices. Collection efficiency up, contamination down, enforcement automated. Predictable cash, tech-enabled. Residents can push back. Some councils cap the number of add-ons, require plain English disclosures, and mandate third-party audits of camera false positives. Others force opt-in for subscription tiers and default households to base service with no nags. A few negotiate data ownership, so algorithms can't hide. But gravity runs the other way. Once a city outsources the tech stack, the vendor's roadmap becomes policy. Watch your own bill. If line items multiply while cart count holds steady, you're inside a subscription ecosystem. If an app offers peace of mind windows that used to be standard, your trash day got product managed. If fine print mentions CPI pass-throughs, fuel adders, disposal indices, and compliance pricing, you're not just a customer, you're a dataset monetized monthly. Cracks in the monopoly wall. Pressure finds seams. After years of quiet, roll-ups and index-linked contracts, small breaks start to open consent decrees, rate hearings, public records that pry open the black box an inch at a time. Start with antitrust. When mergers stack too much control in one metro, the Department of Justice doesn't swing an axe. It files a consent decree. A transfer station must be sold here, a cluster of routes there, sometimes even a landfill interest unwound. It's not revolution. It changes the daily math. An independent hauler suddenly has a gate that isn't priced like a velvet noose. A city can bid service without routing everyone through the same logo's middle mile. That's a relief valve, not a reset, and it still matters. Then the lawsuits. Opacity draws lawyers. Bond calendars stall when governance looks messy. In Pennsylvania, a planned solid waste muni bond sat day to day, with documents hard to find while a shareholder claimed executives self-dealt and headed to mediation. That's not proof of guilt. It is a signal. When financing pauses because light hits the paper trail, leverage tilts back toward the public. Underwriters prefer predictable disclosures. Councils prefer questions answered before rate covenants lock. Municipalization is the blunt end of the wrench. A town drags service back in-house after a bruising franchise cycle. The promise is control, the risk is competence. Done well, it's boring in the best way. Open books, transparent formulas, posted disposal indices, capped add-on fees, and contamination audits presented in daylight. Done poorly, it's missed pickups and the same $80.67 per ton disposal anchor if the region is tight. The difference is preparation. Used trucks bought with eyes open, drivers hired at market, a yard leased near a competitive transfer site, and a disposal deal hedged across more than one gate. Co-ops stitch leverage from fragments. A cluster of towns forms a disposal alliance, pooling tons to meet minimums and win posted rates at a public transfer station. Independents band together to bargain for middle-mile access and predictable dump windows. These aren't glossy launches. They're spreadsheets and MOUs that shave dollars per ton and minutes per turnaround. In a market where private landfills often charge roughly 30% above public sites, that delta can keep a local hauler alive through a contract cycle. Open market ordinances try to reintroduce curb competition for commercial accounts. Prices dip, service tightens, then the bottleneck appears where it always does, the transfer station gate. If every middle-mile door answers to the same corporate parent, choice at the dock meets a toll. Where a publicly owned transfer site sits between street and cell, open markets actually work. Where it doesn't, exclusivity sneaks back through access rules, minimums, and safety schedules. Transparency is the cheapest tool with the highest yield. Public records requests pry loose CPI formulas, disposal pass-through math, and the sources behind regional tipping fee claims. Councils ask for unredacted appendices and receive them. Fuel surcharge timelines get graphed against rack prices, and persistent adders lose their mystique. When residents show up with charts, staff reports sound different. Index alignment can become CPI with floor and cap, subject to review. Regulators can tune levers without headlines. Some states require open access at posted rates for transfer stations financed with tax-advantaged bonds. Others staple reporting covenants to private activity bonds so gate rate hikes need hearings, not just memos. Dry law, but it works. It slows indiscriminate price moves and forces extraordinary adjustments to pass a microphone first. Technology, so often an enforcement ratchet, can become a mirror for fairness. A few councils force vendors to hand over raw camera data for independent audits of false positives before fines stick. Error rates get published. Penalties pause. Education budgets grow where algorithms miss. Queue dashboards outside transfer stations go live, paired with automatic penalties for idling beyond buffers or off-route shortcuts past schools. The same data that shaved a basis point for lenders produces cleaner mornings on the block. Strange bedfellow coalitions form when premiums bite. Developers tired of C&D surcharges pair with small haulers and labor to back a public transfer site. Hospitals captive to steep medical waste contracts lobby for regional treatment capacity under public oversight. Industrial parks bundle e-waste and negotiate posted loading windows at non-discriminatory rates. When enough premium tier buyers align, their tonnage writes a new rule. None of this is linear. Consent decrees expire. Co-ops fracture when one partner chases a discount. Municipal services stumble and reprivatize. Dashboards dim when a contract flips and trade secrets return. The wall doesn't crumble, it sheds bricks. But bricks count. A divested transfer station keeps independence from queuing into oblivion. A bond covenant requires open hearings on gate formulas, so the $80.67 per ton anchor isn't just a sentence in a staff report. A CPI cap with a real ceiling turns an escalator into a negotiation, not a metronome. A city owning its raw route and camera data means penalty thresholds can't hide in vendor code. Copy the pattern, not the headline. Write rate formulas in plain English. Publish disposal indices with sources and dates. Attach floors and ceilings to CPI pass-throughs. Validate camera audits with someone who doesn't sell cameras. Open middle-mile gates when public dollars poured the slab. And ask for one thing, every time on the record, show your math. Personal playbook, cut exposure and regain leverage. You can't unwind a franchise in your kitchen, but you can change how much of it lands on you. Start with the paper trail. Pull your service agreement and circle every escalator. CPI pass-throughs, fuel surcharges, disposal indices, extraordinary event clauses, contamination penalties, cart rental, and replacement fees. If your bill references a city franchise, download that contract from the clerk. You're hunting definitions and triggers, the places where policy becomes automatic price. Build a one-page counterfile. Log your renewal date, cancellation window, and any auto-renew terms that need certified notice to stop. Create a timeline of increases with the stated reason, CPI, fuel, disposal, plus screenshots of CPI prints and rack fuel prices for those months. If you're hit with a contamination fee, request the photo, the algorithm threshold, and the appeal path in writing. That paper trail turns a fee into a claim you can challenge. Right-size what you meter. Most residential bills move with container size and frequency. If you can step down from 96 gallons to 64 or 48, do it. If your city allows every other week garbage paired with weekly recycling and organics, test it. Break down cardboard so lids close. Lid height sensors flag, overflow, even when volume is legal. Keep plastic film out of the blue cart. Cameras love to catch it. If you home compost, ask if the ordinance permits an organics opt-out with proof. If not, fully use organics so you can downsize garbage. Reduce fines before they start. Post a simple, 3-bullet cheat sheet near the bins. No plastic bags in recycling, no food residue, no compostable-looking plastics unless certified. Rinse light. You're aiming to avoid photos, not achieve lab purity. If you're flagged, appeal once with evidence. If false positives stack, email the city's contract manager. There's always one, and put the dispute on the public record. Vendors escalate internally when cities see patterns. For commercial accounts, negotiate like a CFO. Shop 90 to 120 days before term end. Even in exclusive zones, commercial service sometimes has options. Get written quotes anyway. Use them to secure a shorter term CPI with a real ceiling, for example CPI, capped at 3%. A fuel ban tied to a public index with floors that drop, and an education before penalty clause on contamination with photo proof and a human review. If you have peaks, memorialize a seasonal profile, so pickups flex without defaulting to premium on-demand rates. For docks with recurring reclassifications, install signage and a last-look sort table. Document it and ask for a reduced audit fee. If you manage a condo or HOA, centralize and harden. One locked dumpster enclosure with clear signage often beats dozens of carts. Standardize move-in/move-out days and schedule an extra, pull only for those windows. Run a quarterly bulky day with a flat fee roll-off and on-site volunteers to prevent contamination surcharges. If your franchise allows it, request alley exemptions or smaller containers with more frequent service to avoid hard-to-service adders. Pool leverage where you can. Industrial parks and small business corridors can bundle tonnage and bid as a block. Neighborhood associations can ask councils to negotiate common carrier hours at any transfer station financed with public or tax-advantaged dollars. Independents survive when middle-mile access is predictable. If your city points to a regional tipping fee index, ask for sources and dates. In the Northeast, posted averages around $80.67 per ton are the anchor that drives your disposal pass-through. You want to see the math that ties your bill to that anchor. Defend against subscription creep. Default to base service. Decline priority pickup windows, clean cart programs, and assurance plans unless they replace existing penalties at a lower all-in cost. Disable auto-enroll toggles in the billing app. Demand plain language bills with every fee itemized. If your app starts upselling kitchen caddies, liners, or bulky member rates, remember, these offers reduce churn and increase revenue per account. They're not designed for your savings. Use due process. File public records requests for the franchise's CPI. Formula, disposal pass-through calculations, and contamination audit thresholds. Ask for unredacted appendices unless they truly expose protected trade secrets. If fuel surcharges linger after price drops, show side-by-side charts at public comment. One clean graph can knock a temporary adder off the schedule. If your city financed a facility with private activity bonds, insist on open hearings for gate rate changes. The covenants often require transparency if someone asks. Push structural fixes that outlast your lease. Advocate for CPI floors and ceilings instead of ratchets. Sunset reviews on fuel adders. Independent audits of camera false positives before fines resume. And municipal ownership of raw route and audit data. Tie any approval for organics or RNG facilities to revenue sharing or explicit rate offsets when energy credits outperform. If the same ton earns twice, once as a fee, once as gas, money should flow back to rates. For landlords, align leases with bins. Spell out waste rules, lock enclosures, post laminated most find lists, and schedule extra pulls for move cycles. For restaurants, run a 10-minute staff huddle with photos of your top 5 dock violations. Add a last sort bin to catch films and lids. For contractors, pre-sort on-site and negotiate flat contamination allowances in the roll-off contract up front. Require a photo before any reclassification. Finally, watch the calendar. Franchise renewals set your next decade. Show up and ask one sentence that resets the room. Please show the math. If the city publishes indices, sources, caps, and enforcement error rates before the vote, you'll feel it on your bill. If not, the next email at 7:42 a.m. writes it for you. The bigger pattern: utilities as financial products. Once you see the levers on your trash bill, scarcity, CPI ratchets, pass-through indices, and camera-enforced penalties, you start spotting the same fingerprints on other can't-skip parts of life. It isn't a coincidence. It's a financing play migrating wherever demand is captive and cash can be indexed. Start with water. The hearing is called a rate case, not a franchise, but the spine is familiar. A base charge, volumetric tiers, drought surcharges that jump fast and relax slow, and infrastructure fees welded to long-lived debt. Utilities pledge your monthly payment to bondholders, just like a hauler pledges disposal index cash flows. The language is cost of service. The math rhymes with your cart, a formula that moves price without needing more volume. Miss a payment and it behaves like a lien because it is. Now map toll roads and parking. Exclusive concessions turn public space into private meters with CPI or traffic-linked escalators. If traffic dips, terms extend or rates float inside pre-approved bands. Drivers don't negotiate, they pay the new number at the kiosk. The scarcity isn't landfill airspace, it's lanes, curb space, and enforcement apps that turn minutes into revenue. Cameras issue tickets, portals collect, bond appendices cheer automated compliance. Broadband looks competitive until you chase the permits. Last-mile access runs through poles, conduits, and rights-of-way controlled by regulated players. Promotions expire into CPI-ish ladders. Equipment rental fees, modems, set-tops quietly index the base. When providers securitize subscriber cash flows or finance fiber with infrastructure-style debt, they sell the same pitch investors hear in waste. Inelastic demand, sticky customers, automated billing, low churn, and CPI headroom. Stormwater is newer and lands older. Cities roll out impervious surface fees to fund flood control. The meter is your roof and driveway. Rates often index to construction inputs or inflation, then live on the property roll. It's rational policy. Rain falls, systems cost money. It's also a fresh index on your parcel with an enforcement tail that looks and feels like a utility. Insurance isn't a utility, but it's learning the dialect. Models print rate adequacy. Surcharges arrive after storms. Deductibles rise. Coverage shrinks while invoices climb. Reinsurers and catastrophe bonds sit upstream, tranching risk into products that demand steady returns. The household sees a non-negotiable renewal. Finance sees loss trends, index clauses, and premium ladders that resemble disposal pass-throughs. Here's the shared script. Step 1. Identify a service nobody can skip. Step 2. Secure control over a scarce input or gate, permits, poles, lanes, airspace, or legal authority to meter. Step 3. Write contracts or tariffs that index base charges to CPI or market proxies, plus adders for volatility, fuel, drought, catastrophe, disposal. Step 4. Deploy technology that measures behavior and enforces rules automatically. Step 5. Finance scale against those predictable, enforceable cash flows. Your life becomes a basket of subscriptions with clauses designed to move price without begging you to consume more. Regulatory theater makes it feel deliberative. Hearings open, consultants benchmark, comment periods run. Outcomes land inside bands investors forecast months earlier. When shocks show up, droughts, storms, closure of a nearby landfill cell, operators reach for the same tools. Extraordinary adjustments, temporary surcharges, term extensions, and resilience programs that plug neatly into capital plans. The public hears stewardship. The spreadsheet reads protected yield. Trash taught the cleanest lesson because the moats are visible. Disposal permits take years, draw lawsuits, and rarely multiply near dense cities. In the Northeast, the average municipal solid waste gate hovers around $80.67 per ton. That anchor drags every pass-through clause tied to disposal. Private landfills typically charge well above public gates, and that private-public spread behaves like a built-in premium for owning the bottleneck. The Big Three now control roughly 65% of the U.S. market by revenue, Roll-ups hit about $10.9 billion in a single recent year, and the operating stack layers CPI, fuel, and contamination penalties under camera enforcement. That's utility design wearing safety vests. So what do you demand when the pattern shows up on the next bill? Ask for floors and ceilings instead of one-way CPI ratchets. If a tariff cites market index pass-through, require named sources, dates, and public verification. If a program leans on technology-enabled compliance, the city should own raw data, set thresholds in public, and audit false positives before fines land. If a facility or concession uses tax-advantaged or public dollars, tie rate covenants to open hearings and transparent formulas. When energy credits or add revenue outperform, RNG at a landfill, dynamic pricing in a garage, bake revenue sharing or explicit bill offsets into the term sheet. Watch the bundling. The fastest way to turn necessity into a financial product is to stack meters. Base rate, index escalator, volatility surcharge, penalty for behavior, and a convenience subscription you're nudged to accept. If one vendor holds multiple levers, trash, organics, parking enforcement, their dashboards track your compliance across silos. Churn drops. Revenue per account rises. Your household turns into guidance. None of this rejects finance. Pipes, poles, gates, and cells cost billions. Someone fronts the money. The point is refusing autopilot. If contracts write future costs, then the room where indices get inked needs different questions and more eyes. Trash just made it easy to see. Utilities show you where to look next. Why now? And what happens next? The timing wasn't random. After 2002, inflation printed like a permission slip for every CPI clause tucked into a franchise. Index alignment became the talking point. Automatic escalators did the work. Cities under wage and diesel pressure leaned on formulas they'd already signed. Residents heard temporary. Finance heard predictable. And once the index clicked, it didn't unclick at the next council meeting. It waited for the next refresh. Aging infrastructure added its own gravity. Decades-old landfills needed liner repairs, slope work, and gas upgrades. In permit-tight regions, one maintenance window rippled through miles of routes. Trucks diverted, gates closed to outsiders, pass-throughs moved. In the Northeast, where municipal solid waste averages about $80.67 per ton at the gate, a single closure pushes the anchor higher and bakes it into next year's rate. No one votes for that. Scarcity decides and contracts transmit. Capital accelerated the cycle. Pensions and infrastructure funds, hungry for inflation-hedged yield, saw the tells. Inelastic demand, CPI plus escalators, multi-year franchises, and scarce disposal permits. Consolidation sped up. About $10.9 billion in 2024 deals wasn't a victory lap. It was fuel for a model that performs best at scale. With waste management, Republic Services, and Waste Connections sitting around 65% of market revenue, every roll-up densified routes, shortened middle miles for in-house fleets, and captured more tons at owned gates. Cheaper capital followed scale. Higher barriers followed both. Technology sealed the underwriting story. RFID, cameras, and route analytics turned, he said, she said, into time-stamped scans and photos. Mislift disputes collapsed. Contamination went from hunch to image. Lenders didn't need to trust a promise. They could underwrite a process with automated compliance that shaved risk. Add organics mandates, and suddenly there's a third metered stream. Green carts with CPI steps, enforcement, and where private owners control disposal, a second ledger in renewable natural gas credits. So what happens next? Expect 3 moves. First, longer terms and fewer exits. 10-year franchises stretch to 12 or 15, with renewals tied to metrics incumbents know how to hit. Complaints per 1,000 lifts, on-time windows, camera-verified contamination under a threshold. That locks cash flows tighter and drops financing costs further. Second, deeper verticals. RNG from landfill gas stops being other revenue and moves to slide 1. Digesters and industrial composting slot beside disposal. The same banana peel feeds 2 models, fees on the solid side, credits on the energy side. Unless contracts force revenue sharing, those ledgers won't meet on your bill. Third, finer grain pricing. As datasets mature, hard-to-service adders and priority window tiers expand. A handful of pilots will test evening pickups, season passes for bulk, holiday surcharges, and HOA-level compliance packages. The software makes it easy to segment. The franchise makes it hard to say no. On the public side, hearings will sound modern and land familiar. Memos will headline resilience, climate alignment, and workforce retention. Attachments will carry CPI steps, disposal indices, fuel bans, and extraordinary event language that keeps resets sticky. Franchise fees and host fees will stabilize budgets, making councils reluctant to squeeze the same line items that fund parks and payroll. There will be pushback that matters at the margins. Merger remedies will pry loose a transfer station here, a route cluster there. Bond covenants tied to private activity financing will require open hearings for gate rate changes. A few cities will own their raw data and mandate independent audits of camera false positives before fines resume. Co-ops will pool disposal volumes to keep independence alive. Some efforts will stumble. Enough will work to bend the curve a bit. For households, the near-term path is simple: more line items, higher totals, and fewer true opt-outs. Not because anyone's out to get you, but because the model no longer depends on volume to grow. Indices and enforcement carry it. For businesses, leverage comes from timing renewals, bundling buys, and insisting on caps, floors, and photo-backed appeals baked into term sheets. For neighborhoods near facilities, the levers are conditions, dashboards, and penalties that actually trigger. The hinge is procedural. One vote at City Hall sets a decade. If the room demands sources, dates, caps, and open math before ink hits paper, the staircase gets shorter. If not, the next 7:42 a.m. email won't feel like a surprise. It'll feel like a schedule. This is the quiet pivot. Our daily habits turned into indexed cash flows with cameras as referees. If you want leverage before the next term sheet hardens, now's the moment to use it. Subscribe for deep dives on insurance, water, and parking concessions built on the same playbook. Then watch our breakdown of organics and RNG deals. Share this with your council and neighbors before the franchise vote lands.